So there's undoubtedly a lot of change underway within financial services right now. And I imagine that executives are quite concerned about this, because if you look at the shape and structure of the Fortune 500, roughly half the companies that make up that index have disappeared in the course of the last 17 years or so. And of course, nobody actually wants to see that happening to their own organisation. There is a perception that there's an awful lot of change going on right now, and particularly technology-driven change. There's an interesting paper being produced by the Philadelphia Fed in April of 2017, which actually questions whether it's revolutionary change or more of an evolutionary change. And I think here at Fujitsu, we subscribe to the view that it's evolution. One of the examples that the paper cites is a man sitting at a bar lending his friend $20 and comparing how that has now converted into the P2P industry, which works on a very similar basis. It's matching a borrower and a lender. So we see a lot of the change that's taking place in the sector as, yes, having high stakes, but really being driven by technology being introduced to handle greater volumes, to bring a different type of product to the marketplace, but not really to fundamentally revolutionise or change those product offerings. Many of them have been around for many years, but in a slightly different format. The key challenge, we think, for organisations is to handle the volume of change at the moment. And this is an issue that banks and financial service institutions have always struggled with, the ability to balance budgets, skilled resources and time to enable a change program to be delivered. We like to work with our clients to provide them with some of the skill sets and some of the insights that enables them to deliver those change programs in cooperation with ourselves. We believe that by best of the banking industry coming together with the best of the IT industry, we can jointly deliver better solutions which work for all parties and particularly for the clients. So the future of retail banking, that's a really interesting question. Here at Fujitsu, we have a view that one of the key changes we're going to see is that the value chain is going to break up. Now, what do we mean by that? So traditionally, banks have liked to take ownership and responsibility for the sale, production and distribution of their products on an end-to-end basis. We think that going forward, that value chain is going to break up. Established banks will retain ownership of the front end of the value chain. That means owning the customer and the related data, distribution channels, brand. But the back end, which relates to the processing and maintenance of products, will increasingly be shared with other organisations, with third parties, either through an outsourced arrangement or through a service agreement of some form. Now, we can already see that taking place in certain sectors. There have been some new entrants into the Forex market, for example. So some other areas where we think that retail banking is going to change is in the use of open banking and APIs, biometrics and digital currencies. These are three areas which already the marketplace is testing in some way or another, but we think there's got a lot more mileage to come in these areas. So digital transformation creates opportunities in three key areas. The first is lowering costs, the second is improving customer service, and the third is growing revenues. Let's look at costs to begin with. The cost of an average digital transaction has been estimated by some at around 17 cents compared to about $4 for a transaction that involves a branch teller. So it's no wonder that banks have looked at shifting transactions that have previously depended on a manual interface onto new forms of technology that enables them to be handled much more cheaply and much more quickly. That's the reason why UK banks have rolled out around 23 million banking apps in the last 5 or 6 years, because it enables the customers to undertake many of the transactions themselves while also giving the banks the benefits of a lower cost base. Now that leads into the second point, which is about the improvements in customer service. If I don't have to go and visit a branch anymore, if I can handle my banking from anywhere, at any time, and I can get an insight that says, yes, I know that a certain payment has been made, and I can see that the funds are arriving in the recipient's bank account, then that obviously has a service benefit for me. It's an easier transaction to undertake, and I have the certainty of knowledge that the transaction has been completed. That's definitely worth something to the customer base. And the third area, of course, is growing revenues. So technology will open up new opportunities for banks to create revenues. So for example, in Australia, I understand that some of the banks are selling back payment information to retailers so they can improve their opening hours or their staffing schedules to reflect when customers are actually using their stores. Or again, credit card companies are looking at sanitizing some of their payment information and selling it to investment companies that might want to make an investment decision based around the products and services that consumers are buying rather than those that they think the consumer might want to buy. So the opportunity to use technology to create new payment streams, new income streams, is absolutely there. And that's why we're seeing new competitors coming into the marketplace as well. They see the potential that the technology affords, they see the margins that financial services offers, and they see the volumes that can help them generate a healthy return.